It's Friday, 13th of September, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, our new tool to help you identify recessions and avoid panicking over that single data release. But first, Neil Shearing, Group Chief Economist, is with me again to highlight the big issues in macro and markets. And I don't care that it's Friday the 13th. We are lucky to be joined by James Reilly from our markets team. Hi, Neil. Hi, James.
Hi, David.
Hi.
Now, big things to watch for in the coming week. I can't think of anything. Can you?
No, quiet week ahead.
Yep, no, quiet. Nothing going on. I mean, come on, 25 basis points or 50 basis points. How is the Fed going to start its easing cycle? Market pricing has been bouncing around on this question for days now. It's been a bit nuts, really, hasn't it? We're midday Friday, London time, as we're recording this. Neil, what are we going to get from the Fed on Wednesday?
Well, you're right. It's bounced around all over the place over the past 48 hours. It had seemed that August CPI data had been the final nail in the coffin of a 50 basis point hike, slightly stronger core CPI numbers, albeit only due to shelter. So following that release, the possibility of a 50 basis point cut pretty much priced out of the market. And then on Thursday night, drop a couple of pieces in the Wall Street Journal and the FT, seemingly starting to talk up the chances of a 50 basis point cut. So it's still in the balance. For what it's worth, our view is that 25 basis point cut is more likely. We can get into the reasons why we think that's the case. But I suspect that right up until the meeting, the market price is going to be bouncing around, like you say.
Yeah, I know last week I said CPI was the big release before Wednesday's announcement, but we've got August retail sales and industrial production on Tuesday. Given how the single data releases have been driving this easing narrative around, as you say, it does sound like this is a decision that's going to go down to the wire. Could there be surprises between now and Wednesday's announcement that dictate whether we get a smaller or larger start to this easing cycle?
Well, they could. I don't think there necessarily will be in the data. It would need to be a pretty catastrophic fall in any of the activity data to swing decisively to 50 basis points, or equally extremely strong to rule out the possibility of 50 basis points. And in our view, it's going to be a pretty mixed bag. So we've got retail sales down 0.2%. It looks like motor vehicle sales have started to fall. That's a bit of a concern. On the other side, industrial production up 0.5%. That's a bit of a rebound from the auto shutdowns that disrupted production in July, and also a bit of a rebound from the hurricane that disrupted activity in July too. So probably nothing decisive from the activity releases this week, just ahead of the FOMC. Of course, the FOMC will see this data too. So I don't think there's going to be anything in the data. Instead, I think it's really coming down to a judgment of FOMC officials. Of course, what's complicating matters even further is that it's not necessarily about a 25 basis point cut or a 50 basis point cut. You can get a hawkish or a dovish cut, because we're also due an updated summary of economic projections from FOMC officials that will include projections for interest rates. So it's possible that officials could choose to cut by 25 basis points, but flag the likelihood or their expectation of a 50 basis point cut over the coming months in those projections.
And I know there's 50 basis points priced into markets for meetings beyond September. I mean, just taking a step back, Neil, what is the rationale for starting with a 50 basis point cut?
Well, I think it's pretty simple, really. If you no longer believe that this degree of monetary restriction is warranted and that the economy is slowing, then you get on pretty quickly and remove monetary restriction. So you cut pretty aggressively if it is indeed the case that you believe it is no longer warranted. And of course, we've seen in the data, the labour market's clearly cooling now, that we've got clear signs of that, not just in the payrolls numbers, but in other indicators too. We have some signs of the survey data. The survey data has been pretty soft, but the activity data is by and large holding up. So certainly mixed signals from the real economy. I think one of the key points from my perspective is not try and step back a bit from the economic data and think about the circumstances under which a central bank cuts by 50 rather than 25. And there's quite a high bar, I think, to doing larger rate cuts, despite it seemingly being justified by the data. One is that implicitly it requires the central bank to admit they've made a mistake. They've kept policy too tight for too long. They've fallen behind the curve, however you want to put it. Another is that it's a really difficult communication skill to pull off cutting aggressively. It requires the central banks, and this is not just true of the Fed, by the way, it's true of every central bank, to be able to say to markets, look, we're removing monetary restriction because we think it's warranted. But by the way, don't panic about the economy. We've not driven the economy into recession, because if they do miscommunicate it and recession fears do start to surface, then what happens is you get equity markets collapsing, credit spreads widening, financial conditions tightening. And of course, that's the exact opposite of what they're trying to achieve. So it's a really, really difficult piece of communication to pull off. I think for that reason, it tends to be, when you look through history, that you tend to get 50 basis point cuts, large 50 basis point cuts, reserved for times and situations where the economy really is sinking quite quickly. So if you look, think about 2007, the COVID recession, the 2001 bursting of the dot-com bubble, we got 50 basis points cuts to kick off the easing cycle then. But mid-cycle adjustments, soft landings, when the economy is by and large holding up, but the Fed believes it needs to remove some monetary restriction, have over the past 30 years all begun with 25 basis point cuts.
That's a great segue to bringing James into this discussion. James, there's this big question about how markets are going to respond as rate cuts get underway in the coming week from the Fed. You've done the analysis on more than 6 decades worth of moves in the Fed funds rate and how they influenced asset prices. So tell us what you've learned from looking at 11 Fed easing cycles going back to when JFK was president.
Yeah, sure. So one of the key takeaways is that it really depends on whether you get a US recession or not during the easing cycle. So in those 11 cycles that we've looked at, 7 coincided with recessions and 4 did not. Unsurprisingly, when there is a recession, the Fed ultimately cut interest rates by a lot more than when there wasn't. So an average of about 420 basis points in those cycles with recessions compared to just 160 without. In terms of what that means for asset performances, well, in general, the S&P 500 has actually fared worse during easing cycles than outside of them. But again, that's skewed by the fact that 7 of these cycles coincided with recessions. In those easing cycles where there wasn't a recession, the S&P 500 actually outperformed compared to its normal annualized average. In that report, we also looked at, for example, the returns from 2 and 10-year treasuries. We found that, in general, 10-year treasuries outperform during easing cycles unless the Fed underdelivers on rate cuts compared to investors' prior expectations. And that is ultimately what we're forecasting to happen this time. So over the next 12 months or so, we think 2-year treasuries will probably outperform 10-year treasuries as the curve steepens.
So it comes down to recession, no recession, and if there is no recession, then the Fed doesn't ease as much, and we don't have a recession in our forecast, therefore we don't expect as much Fed easing, therefore we think that market pricing has gone too far in the other direction. But let's talk about your analysis, talk about what you've learned with reference to what we're expecting this coming week. There is a debate in the market, isn't there, about whether if there is a 50 basis point move, and that's not our forecast, but if there is a 50 basis point move from the Fed on Wednesday, whether that would be greeted as bullish or bearish. With all that in mind, what do you think this easing cycle is going to mean for markets?
Yeah, so that question of what would a 50 basis point cut this time mean? One way we can try and get a sense of that is just by looking at market pricing or market developments on Thursday night, when this report came out from Wall Street Journal that increased the perceived odds of 50 basis point cuts next week. Yes, you had treasury yields fall in response to that, but you also had the stock market rally, which suggests that from investors' point of view, the more rate cuts, the better. Now, of course, the problem from here is that we have about 120 basis points of cuts discounted at the next 3 meetings. So that's, if you like, 4.5 25 basis point cuts. The short point is, from here, to get further rate cuts discounted, you'd think that probably that requires more serious concerns over a US recession. And that backdrop, as our analysis shows, is one in which equities tend to actually fall. And it's one in which the US dollar tends to appreciate a bit thanks to safe haven demand.
Neil, I want to bring you back in here because before we go, there is another central bank meeting in the coming week that is worth discussing for a bit. The Bank of England, it feels like a more finely balanced decision than the Fed's in terms of whether they're going to cut again or decide to hold at this meeting. How do you expect that to play out?
Yes, obviously they cut in August. Our sense is they won't follow up with another cut at the meeting this coming Thursday. That's pretty much priced into the market. I don't think there's many people out there expecting another cut. So all eyes are going to be on the communication. Will they flag cuts at forthcoming meetings? Our sense is yes, we probably will get another 25 basis point cuts at the next MPC meetings in November and December. But the market pricing is pretty aggressive over the next 6 months in terms of rate cuts. We don't necessarily disagree with the endpoint. In fact, our endpoint for UK rates is a bit lower than what's priced into the market, but we get there a bit more slowly than the markets are anticipating. If you think about the extent of pay pressure still in the labour market, the fact that the activity data, they've certainly softened in the UK over the past couple of months, but they're by no means disastrous. And of course, we've got the budget coming up at the end of October. So all eyes on fiscal policy there. And I suspect it might come out of that with a fiscal stance that's perhaps a bit looser than had been baked into the Bank of England's forecast and plans. So put all that together, don't think the pace of easing in the UK over the next 3-6 months is going to be quite as aggressive as the market's pricing in. But the end point of the journey might be that we end up with rates still a bit lower than the markets are pricing in eventually.
That was Neil Shearing and James Reilly talking about a big week ahead for central banking and a big week for markets. I'll link to James's analysis and an interactive dashboard of data that accompanies it. It's a mine of monetary and market data that show what Fed easing cycles have done to asset returns in decades gone by and kind of signpost what to expect from this coming cycle. It's available to CE Advanced clients along with all of the underlying data to export via Excel. Learn more about how our data can help your decision making at capitaleconomics.com/data. And staying on data, at the beginning of last month, global markets fell out of bed when a US jobs report came in way below expectations. That was a single data release, but it was enough to stoke fears that the US economy was finally in recession or heading into recession, except that what happened next was a series of releases that showed quite the opposite, including some retail sales numbers that suggested the US consumer was doing just fine, thank you. That payrolls report highlighted the absence of a clear single indicator that shows if recession is here. And it's not just the US economy. Across developed markets, investors have needed clear data guides that just cut through the noise and tell them whether or not recession is here. Step forward, Simon MacAdam. He's our Deputy Chief Global Economist, and he's just created Economic Momentum Indicators, which is a catchily titled dashboard that shows you whether economies are going into recession. Simon spoke with his teammate Ariane earlier in the week about the indicators, and here's that conversation now. It begins with Simon explaining his rationale and his approach.
It's really important that we get a general sense of distilling lots of individual indicators, lots of information, into a summary overview and understanding about how economies are performing in as close to real time as possible. There are a few approaches to distilling and reducing a lot of information down to a summary indicator. Some of them much more technical than others. What I've done in my recent report anyway is to just average across a lot of indicators. I mean, there are fancier approaches, but to be honest with you, I've looked at those and they don't really add very much beyond a good old-fashioned mean of the growth rate of what we've looked at is about 12 different indicators. So if you just get a dozen economic indicators that are internationally consistent, we're talking things like manufacturing output, construction output, but we're also looking at some survey data about consumer confidence and manufacturing orders, look at some financial sector and credit market data as well, combined with indicators from the labour market across 8 advanced economies. Going back many decades, we've got a really good data set to work with there. And then we can just average across these components. That gives us a general sense of how the data are going, because you can have 1 or 2 indicators that are seemingly flashing recession, but then there might be 1 or 2 other indicators that are pointing to completely the opposite, right? So if you average that out, that would not be flagging recession. In order for an average of the data in general to be pointing to recession, you're probably, in most cases, that would suggest that there are lots of indicators that are deteriorating at the same time. So that's what we've done. We've come up with this summary measure. I've called them the economic momentum indicators, but they really are just about an average of the data to give us a general take, a stock take of how an economy is performing overall.
Okay, so in your work, you also looked at how well these composite momentum indicators coincided with recessions in the past. And they seem to do a pretty decent job of detecting when advanced economies have entered recessions, don't they?
Yes, done a pretty good job. So, I mean, if you look at the 4 decades before the pandemic, so from 1980 through to 2019, these indicators, when they breach a dangerous threshold, they have only missed 3 recessions in these 8 advanced economies. So that's a hit rate of 90%. And even in 2 of those cases, I would argue that in 2 of those cases, the indicators got very close to that danger threshold. So 2 very near misses there. And then that 3rd miss was German reunification, which is a bit of an odd scenario, having a contracting economy join your economy. It wouldn't obviously show up in some monthly economic indicators dominated by West Germany at the time. So I like to think that it's got close to a clean sweep in terms of capturing recessions at a fairly early stage as well. Because the thing you've got to remember is that, particularly if you're going by a definition of recession whereby you want consecutive quarterly declines in GDP, by the time you've established that fact that there have been 2 or more consecutive quarters where there's been a fall in GDP, 9 months or so has passed. So in order to be able to actually detect at a very early stage whether an economy has gone into recession, you need to be looking at these timely indicators. And what these economic momentum indicators suggest is that we can have a fairly good stab at working out whether we are in a recession or not many months before it becomes officially the case in the national statistics.
All right. Yeah. So pretty good track record in the past. I guess then, can you talk us through what the indicators are showing now? And I guess in particular, whether they're suggesting that recession risks are either high by past standards or that some economies might be flashing red?
Yeah. So, I mean, the upshot is that at least going by past experience, these indicators are not flashing red in any advanced economy. So, I mean, we've looked at the US, Canada, Japan, the UK, and then the big 4 in the Eurozone, so Germany, France, Italy, and Spain. And in no case do we have flashing red. The indicators flashing red, that means that none of our momentum indicators are nearing that are particularly close to that danger threshold that we've identified. So that's the first point to make. But there are 2 caveats along with that. I mean, one of them is that there is a difference across countries. So I think it's fair to say that the evidence suggests that North America, both the US and Canada, have got a slightly higher risk of being in recession imminently than other advanced economies, but not to a massive degree. But there is some sort of cross-country difference there that's worth pointing out, and that's somewhat consistent with some of the fears that people have had about whether the US was falling into recession, which feeds into debates about whether the Fed is going to be cutting by 50 basis points or 25 basis points as it kicks off its easing cycle. And the third point to make is, look, whilst we've historically had a really good track record, we wouldn't want to suggest to anybody, it would be disingenuous to suggest that the indicator is flawless and therefore they could be wrong and there could be a recession around the corner. But so far, so good that we don't get the sense that advanced economies are tumbling into meaningfully deep recessions.
Okay, yeah. So recession risk slightly higher in North America and the US, as you say, than in some other advanced economies. But essentially with these indicators, you're trying to make the point that even though there's been a lot of talk about potentially the US falling into a recession, that might be focusing too much on one of these indicators that we've often heard quoted, or kind of a visible trend that we've seen in recessions in the past, like the triggering of the Somme rule or yield curve inversion. So you're saying that kind of this fear in the US is a bit overdone.
Essentially, yes. The point I want to stress is that context matters. So when people focus on something like the Somme rule, when that indicator has triggered, when the unemployment rate has, risen by more than 0.5 percentage point relative to its minimum in the past 12 months on a 3-month average basis, when that happens, lots of other things are happening too, right? So other economic indicators are flashing orange or red. The point this time around is that, yes, the Somme rule is triggered, and yes, there are some other weak spots in the US economy, but you haven't got the sort of broad-based weakness that has often accompanied a triggering of the Somme rule in the past that did correctly flag a recession. So that's the really key point I want to stress, that individual indicators just cannot be relied upon, even the really good ones, because context matters. You need to be seeing other things as well. If you're going into a meaningful recession, clearly, almost by definition, you're going to see areas of weakness popping up in many places, not just showing up in one place. But there's something else I would stress here is that, this is focusing on the SARM rule in the US, but whilst we've developed these economic momentum indicators across advanced economies, at Capital Economics, we do have a sort of a dedicated analysis around likely scenarios for the US economy in the near term, and a whole dashboard and analysis underpinning all of that. So if we look at that chimes with what we're seeing in the momentum indicators in terms of suggesting that whilst there is a non-negligible risk of a hard landing and recession in the US in the near term, the base case is still that the US is on course for a soft landing.
Yeah, I guess one last thing that might raise some questions from your indicators is, I guess, why recession risk in Germany is supposedly mild. I mentioned earlier that kind of weak industrial production reading in July, and really the German economy has barely grown in the past couple of years. So, it's gained this label of the sick man of Europe. So can you explain how that all adds up, I guess?
Yeah, Germany's economy is very weak, and needless to say, its industrial sector is not just cyclically weak, but it's structurally weak, right? Even if you go before the interest rate hikes, if we go before the energy crisis sparked by Russia's invasion of Ukraine, we go before the pandemic, there are already signs that German industry was in a bit of a structural decline, lacking, it's lost competitiveness over the years. Globalization isn't quite the driving force for growth as it once was. And I think that's all fed into a story about prolonged industrial weakness in Germany. Whether that is consistent at the moment, whether the evidence broadly taken in the whole are consistent with the German economy toppling into a meaningful recession, we're not seeing that yet in the data. There are clearly weak spots, as there are in other advanced economies. And I think the general story with what we're seeing in the data so far is that we're seeing a German economy that's stagnating, that's struggling to grow, but we're just not seeing the sort of signs of an economy that is about to tumble into a much more meaningful recession, where you see big falls in GDP and significant increases in unemployment. So it's true that the German IP falling by, was it 2 or 3% in July? That's quite a big deal. But as I've been stressing throughout this episode, detecting recessions is also about looking through individual indications. It's about looking through a noise in the month-to-month data. That could be really telling that German industry is really going into a deep downturn. But at this stage, it's too early to declare a high risk of a recession for the economy as a whole. But clearly, German recession risk is one to watch, and we'll be monitoring it closely on our dashboard in the weeks and months ahead.
That was Simon MacAdam talking to Ariane Curtis about our new economic momentum indicators. Like James's work on the Fed and asset prices, there's an in-depth report and an interactive dashboard with accessible and exportable data. The aim of data tools like these is twofold. They're designed to save you the time of having to do the analysis yourself, but they're also intended to give you insight that, frankly, you can't get anywhere else. I'll link to both and to our data page again, so you can learn about the many solutions we've got like these to help your decision making. But that's it for this week. We're going to be back next week to look at what the Fed did and how financial markets responded. We'll also be looking at what the Bank of England decided to do, but we'll also be looking at this Federal Reserve easing cycle through the prism of emerging markets, along with much more besides. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.